All right, let's talk about something every single Canadian business owner has to deal with: GST and HST. It can feel complicated, I know, but it's a huge part of your financial life. So today, we're going to pull back the curtain and demystify the whole system. We'll focus on exactly what you need to know right now for 2024, from the big rule changes to how you can make sure you're getting back every penny you're owed. And just so you know, this entire explainer was prepared by Samir Al-Rishani, PhD, with AI support. So here's how we're going to break it all down. First, we'll cover the brand new tax changes for this year. Then, we'll build a really solid foundation, making sure we're all on the same page with the core concepts. After that, we get to the fun part: mastering input tax credits. That's the getting your money back part. And finally, we'll wrap it all up with the practical stuff: filing, paying, and just generally staying on the CRA's good side. Okay, let's get right into it. First up, the key changes for 2024. And look, it doesn't matter if you're a seasoned pro or just starting your first business, staying on top of these annual updates is absolutely essential. It's how you avoid nasty surprises and keep your cash flow healthy. This year, there are really three big things you need to have on your radar. The big one is that electronic filing is now mandatory for pretty much everyone. We'll get into that. There's also a new lower limit for when you have to make electronic payments. And then there's some good news. The government has increased the cost limits for business vehicles. So the first big number to burn into your memory for 2024 is this one: $10,000. As of January 1st, if you have any single payment or remittance to the government that's 10 grand or more, you have to make it electronically. You can't just mail a check anymore. For those larger amounts, the paper era is officially over. Now for that good news I mentioned. This is a big deal if your business relies on vehicles. The capital cost allowance ceiling, that's basically the maximum price of a car the government will let you write off over time, has been bumped up to $37,000. And if you lease, you can now deduct up to $1,050 a month. These changes are meant to keep up with rising car prices, and they give you a little more breathing room on your expense claims. Okay, so now that we're up to speed on the new stuff for 2024, let's take a quick step back and make sure we've got our foundation solid. We're going to cover the absolute core concepts of GST and HST. You know, you've got to speak the language to play the game, and getting this stuff right from the beginning saves you so many headaches down the road. The entire universe of GST and HST revolves around this single term: taxable supply. Honestly, it sounds more complicated than it is. Put simply, if you're in business selling a product or a service, chances are you're making a taxable supply. And if you are, that's the trigger. That means you have to charge and collect GST or HST on that sale. Well, with a couple of important exceptions we're about to see. Now, this is a big one. This is a distinction that trips up so many business owners. So let's make it crystal clear: zero-rated versus exempt. From your customer's perspective, they look the same. They don't pay any tax. But for your business, the difference is night and day. Here's the key. For zero-rated supplies, you still get to claim back the GST/HST you paid on your business expenses. But for exempt supplies, you don't. That's it. That one difference has a massive impact on your bottom line. So does every business have to register and deal with all this? Well, not necessarily. It all comes down to what's called the small supplier threshold. The magic number is $30,000. If your total revenue from taxable supplies worldwide is $30,000 or less over any 4 straight quarters, so basically a year, you don't have to register. But the second you cross that line, it becomes mandatory. Let's make this real with an example. Check out this business. The key thing is that you're always looking at a rolling 4 quarters. So you add up Q2 of 2023, Q3, Q4, and then Q1 of 2024. And what do you get? $32,000. Boom. They just crossed the $30,000 line. That means they're not a small supplier anymore, and they have to register for a GST/HST number. All right, now for my favorite part, and probably yours too: getting money back from the government. This section is all about input tax credits, or as we call them, ITCs. This is the whole mechanism that makes the system fair for businesses. It's how you recover the GST or HST you spend on your day-to-day business expenses. So what exactly is an ITC? Think of it like a refund. Every time you buy something for your business, whether it's supplies, a service, whatever, and you pay GST or HST on it, you get to claim that tax back as a credit. The whole point of a tax like this is that the final consumer is the one who pays it, not the businesses in the middle. ITCs are how that actually works in practice. You collect tax on your sales, claim credits for tax on your purchases, and you just send the difference to the government. But, and this is a really big but, it's not a free-for-all. You can't claim ITCs on just anything. The CRA has some very firm rules. For instance, that golf club membership you use for networking? Sorry, that's not claimable. Anything that's clearly for personal use is a no-go. And remember what we just talked about? If you buy something to help you provide an exempt supply, you can't claim the credit for it. So what about things you use for both business and personal life? The classic example, of course, is a home office. You just have to be reasonable and allocate. Let's say your utility bill has $80 in HST on it, and you've calculated, maybe based on square footage, that 70% of your home is used for business. Well, the math is simple. You can claim an ITC for 70% of that $80 in tax. That works out to a $56 credit right back in your pocket. Here's another one that gets people all the time: taking clients out for meals or entertainment. The rule here is simple, and it is firm. You can only claim back half of the GST or HST that you paid. So even though you pay 100% of the tax at the restaurant, you only get a 50% ITC on your return. Just burn that 50% number into your brain for meals and entertainment. Okay, I get it. Adding up the tiny bits of GST or HST from every single receipt, every coffee, every pack of pens, it can be a ton of work, right? It's time-consuming, especially when you're just trying to run your business. So you're probably asking yourself, there's got to be an easier way to do this, right? And the answer is yes, there is, for some businesses at least. It's called the simplified ITC method. Now there's a catch. Your business has to have $1 million or less in annual revenue. But if you're eligible, instead of tracking the exact tax on every purchase, you just add up the total amount of your eligible purchases, including the tax, and multiply that grand total by a special fraction. For GST, it's 5 divided by 105. Believe me, it can be a massive time saver. Okay, let's bring this all home. We've talked about what to charge and how to get your money back. Now for the final critical piece of the puzzle: actually filing your returns, sending the government their money, and, staying out of trouble. This is where getting your processes and deadlines right is everything. And this brings us right back to one of those huge changes for 2024. And I really need you to hear this one. Electronic filing is now mandatory for almost everybody. The old revenue threshold is gone. So unless you're a charity or fit a few other very specific exceptions, the days of mailing in a paper return are over. You have to file online. Now, the CRA did give businesses a little time to adjust. They had a grace period for the first quarter of 2024 where they waived the penalties for businesses that were new to this rule. But, and this is the important part, that grace period is over. As of April 1st, 2024, the penalties are in full effect. If you're required to file electronically and you don't, it's going to cost you. And let's be very clear about what that means. This isn't a one-time slap on the wrist. You can get hit with a penalty for each and every single return you file by mail when you shouldn't have. Those penalties can add up incredibly fast, so it is absolutely vital that you get your electronic filing process locked down now. All of this brings us to one last question, and I want you to really think about it. With all these rules, all these calculations, is your business audit-proof? I mean, if you got that call from the CRA tomorrow, would you feel calm and confident, or would your stomach just sink? Because having great records isn't just about compliance. It's about giving yourself peace of mind. But here's the good news. You are not alone in this. The CRA actually provides some excellent resources to help you. Your My Business account on the CRA website should be your new best friend. It's where you file and track everything. If you find a mistake from a past year, don't panic. Look into the Voluntary Disclosures Program. It can seriously reduce or even eliminate penalties. If you're in a really tricky situation, you can ask for a formal ruling. The point is, these tools are there for you. Use them. It will make your life and managing your GST/HST so much less stressful.